Welcome to the Deep Dive. Today we're jumping straight into Figma's Q2 2025 earnings, the numbers, the surprising stock reaction, and what it all means.
Yeah, and it's their first report since the IPO, so, the market's reaction feels extra significant. Lots to unpack here.
Absolutely. Let's get right to it because this is, well, a bit of a head scratcher. Figma beat revenue estimates for Q2. They hit $249.6 million. Expected was $248.8 million.
Okay.
And their guidance for Q3 and the full year also beat what analysts expected. Sounds good, right?
Seems like it, yeah.
But then the stock just plummeted, down 13%, $9.20 a share, 13.51% in late trading Wednesday. So what's going on?
That's the immediate puzzle, isn't it? Because you look at the Q2 numbers themselves, and they look, well, pretty strong. Revenue hit $249.6 million.
Which is a big jump from last year.
Huge jump. 41% year-over-year increase from $177.2 million in earnings per share. Breakeven. Plus, they actually posted net income, $846,000.
Wow. Compared to that massive loss last year, that's quite the turnaround.
Massive. They lost almost $828 million in Q2 2024. So, yeah, big improvement. Adjusted operating income was $11.5 million, right in their target range.
Okay.
That gives them a 5% non-GAAP operating margin. And cash flow looked healthy, too. $62.5 million from operations. Adjusted free cash flow, $60.6 million. A 24% margin there. Pretty solid financials all around.
So, okay, if the Q2 results were solid, even good, what was it in the forward guidance that spooked the market so badly? It wasn't a revenue miss, clearly. Was it the growth rate?
That seems to be exactly it. The focus shifted immediately to the rate of future growth. Even though the guidance numbers technically beat consensus estimates, the implied growth rates seem to cause concern.
Okay, break that down for us. What did they actually forecast?
Right. So for Q3, they're forecasting revenue between $263 and $265 million. The LSE consensus, that's the analyst average estimate, was $262 million. So they beat that.
Okay.
But that range implies about 32% year-over-year growth at the midpoint. And for the full year 2025, they guided to $1.021 billion to $1.025 billion.
Which also beat the consensus, right? That was $1.01 billion.
Exactly. Beat that too. But again, the implied growth rate is around 37% year over year at the midpoint.
Yeah.
They also gave full year non-GAAP operating income guidance of $88 million to $98 million.
Ah, okay. So the actual dollar amounts are higher than expected, but the percentage growth is maybe lower than investors wanted to see. I think I saw CEO Dylan Field mention something specific about this.
Yeah, he did.
Something about dev mode sales from last year.
Exactly. He pointed out that the strong momentum they had from selling dev mode, which helps developers use the designs last year, is, in his words, putting a damper on revenue growth for the third quarter.
So that creates a tough comparison.
Precisely. It raises that question for investors. Is this a sign of a slowdown? Even if the company is still growing nicely in absolute terms. You saw that CNBC headline, right? Figma shares slide on revenue growth rate outlook.
Yeah, that nailed it.
For a company just out of the IPO gate, valued heavily on disruption and aggressive expansion. Well, even a slight deceleration can make investors nervous. They're often chasing that hyper-growth phase.
So a lower projected growth rate, even while still beating estimates, signals maybe the peak growth is past, especially with that tough dev mode comp from last year, making this year's percentage look lower.
That seems to be the market's interpretation, yeah? Is it temporary? Or is it a sign they can't maintain that really premium growth story, especially when they're investing so much?
That makes sense from a market reaction standpoint. But is it entirely fair? I mean, what are they actually doing to drive future growth? Because companies like Figma plan longer term than just one quarter stock reaction. They doubled their product offering in Q2, didn't they?
They did, and that's crucial. It shows their long-term focus, their willingness to take big swings, like they said. It's fascinating, really, how they're expanding beyond just the core design tool.
What were some of the big launches?
Okay, so in Q2, they rolled out quite a bit. There's Figma Make that's AI-powered. You can basically describe an app or website design, and it helps compose it.
Sort of like an AI first draft?
Kinda, yeah.
Yeah.
Then Figma Draw for better vector editing, more illustration power. Figma Sites actually turns the designs into working websites. And
Yeah.
Figma Buzz for marketing assets. Plus, on the developer side, Dev Mode MCP server, which connects the design context to AI coding tools to try and speed things up for developers.
That's a lot of new stuff.
It is. And they shared a stat. Over 80% of their customers use 2 or more Figma products in Q2. 2/3 use 3 or more. They're clearly pushing to become the central hub for, like, the whole creation process.
And the AI angle seems huge. Dylan Field had that interesting take. Something about AI making the human touch more valuable for designers.
Yeah, his quote was, the more that software becomes easier to build with AI, the more that people are going to see that human touch is needed. It's a counterintuitive take for some.
Definitely. Many designers worry AI will replace them.
Right. But Field seems to believe AI elevates human creativity, positions designers more strategically. And these vibe coding tools they mentioned.
What exactly are those?
Well, it sounds like AI that doesn't just translate design to code literally, but tries to capture the intent, the feel, the vibe of the design, bridging that creative technical gap more intuitively.
Interesting. And they made acquisitions too, right?
They did. Two strategic ones. Modify, which is a vector graphic startup focused on motion and animation, so deeper visual capabilities.
Okay.
And Payload, a headless content management system, or CMS startup. A headless CMS basically separates the content from how it's displayed.
Giving more flexibility across different platforms like websites, apps.
Exactly. More flexibility for designers and devs. Both buys really fit that strategy of building out a complete integrated platform for, the future of making digital stuff.
So lots of investment in the future. But how's the core business holding up right now? What about customer retention, customer growth? Is the foundation still strong?
Good question. Let's look at the Q2 customer metrics. The net dollar retention rate that's key for SaaS, measure spending from existing customers, was 129%.
Okay, 129%. How does that compare?
It's down just slightly from 132% in Q1. Now, that tiny dip might make some people pause. Could be saturation, maybe some churn with all the new products.
Or maybe just reflects different customer types coming in?
Could be. It's something to watch. But 129% is still really strong. It means high-value customers are still spending significantly more over time. And they grew their customer base, too.
The high-value ones?
Yeah. They now have 11,906 paid customers, spending over $10,000 a year. And the really big ones, spending over $100,000 a year, grew to 11,119. That's up from 1,031 in Q1.
Okay, so they're definitely still landing and growing those larger enterprise deals. That's a good sign.
Very positive sign for stability, absolutely.
And what about their cash overall, their financial cushion? I think I saw something kind of surprising about their investments.
They're sitting on a healthy pile of cash, about $1.6 billion in cash, equivalents, and marketable securities as of June 30th. But here's the kicker, the really interesting part.
The Bitcoin part.
The Bitcoin part.
Oh.
They have $90.8 million invested in a Bitcoin ETF.
For a design software company, that's unexpected.
It is. Dylan Field addressed it directly, said, we're not trying to be Michael Saylor here. It's a design company, but I think there's a place for it in the balance sheet and as part of a diversified treasury strategy.
Okay, so diversification is the official reason.
That's the line. But, for a company like Figma, investing in Bitcoin also sends a certain signal. It aligns them with a more tech-forward, maybe even Web3-ish kind of audience.
So maybe more than just treasury management. A subtle nod to future directions. Decentralized tools, crypto payments, NFTs even.
It's speculative, but it's possible. It definitely feels like a progressive move, and it certainly turned some heads.
Definitely a unique strategy. Okay, so we've talked growth rates, products, customers, even Bitcoin. What about the stock itself? Post-IPO, lockups are always a big factor. What's happening there? Could that affect the price soon?
Yeah, that's super relevant, especially after a price drop. There are two main things happening with lockups according to the sources. First, there's an early lockup release.
Okay.
About 25% of certain employee stock was set to unlock basically right after earnings after market close September 4th, tradable September 5th.
Was there a condition for that?
Yes, the stock price had to stay at least 25% above the IPO price, which was $33 for 5 straight trading days, including one day after these earnings. And since the stock closed Wednesday at $68.13, they easily met that.
So potentially more shares hitting the market very soon.
Could be, yeah. Then there's a second part, an extended lockup. Some big investors, holding about 54% of the Class A stock, agreed to stagger the release of their shares.
Stagger them how?
In chunks tied to future earnings announcements, with the final bit, 35% of those shares not expiring until August 2026.
And Dylan Field made a point of mentioning this.
He did. He said, that's something that I think is valuable information. Seems like they want to provide clarity, maybe calm nerves about a sudden flood of shares later on.
Right, trying to manage that supply-side visibility for investors. Okay, so let's try and wrap this up. This deep dive into Figma's Q2, it really shows this interesting conflict, doesn't it? Strong, actual performance beating revenue, guiding higher, really ambitious product innovation, especially with AI, good customer growth, solid cash, even that quirky Bitcoin play.
Right.
But the market reaction was negative, focused almost entirely on that slightly slower rate of future growth, those tough year-over-year comparisons, not the absolute number.
Yeah, it tells you a lot about the current market mood, doesn't it?
Yeah.
Especially for these newly public tech darlings investing heavily in areas like AI, growth versus profitability. It's a tricky balance.
It's not just about beating anymore.
No, it's about the rate of the beat, the narrative going forward.
Yeah.
So for you listening, what's the key takeaway? What should you watch next?
Good question.
Keep an eye on whether Figma's big product bets, especially in AI, start translating into accelerated growth in the next few quarters. Will that shift the market's view? Or is this slightly lower growth rate the new normal investors expect as they weigh innovation against those immediate growth metrics? It's really a fascinating story playing out a company pushing hard on innovation while navigating tricky investor expectations in a really complex market.